and welcome to a brand new episode of Smart Money. Now, the markets are close to record highs and foreign inflows into India this year so far has been the highest since way back in 2020, with almost $13 billion coming into the Indian markets from FPIs. But with the markets at all-time highs, there are also a few red flags and perhaps mistakes that you should avoid. Today, we talk about those mistakes that you should avoid in this market. So we always tell you what to buy, but now perhaps we'll tell you what not to do in this market. Our expert today is Vishal Kapoor, the CEO of Bandhan AMC. Vishal, thank you so much for joining us on the show. This is an interesting time, right? Because generally when the markets are at all-time highs, investors have that FOMO feeling, so to speak. But before we get into the mistakes that you should avoid, how are you feeling about the markets now?
We're actually quite optimistic. I think, yes, people are talking about all-time highs, etc., but we'd encourage investors to look at valuations more than just the index level. And, valuations, I think, from different perspectives do look reasonable in that sense, and therefore, we wouldn't be too worried, especially if you're a long-term investor.
Okay, don't be worried if you're a long-term investor, folks. But let's move on. There are a couple of mistakes that we have identified that you can avoid in your investing journey. One of them is staying on the field, but with no goal post. Explain that to us.
So, Sonia, one of the things that, and, this is just a caveat that, these are just observations from people, speaking to people, looking at data. So these are not definitive sort of do's and don'ts. These are merely what we feel and see, and therefore just want to caveat. And one of the things is, just using a soccer or football analogy, it's good to see a lot of people on the field, so many investors coming into the market. But what we sense is sometimes we're just running around without really having a goal post. And the reason we say that is, for example, when we look at people coming to our website as an instance, there's 3 times the amount of time spent looking at performance of our products rather than looking at goals and all the wonderful tools that a website typically offers you to sort of look at what do you really want to do. Similarly, when we look at SIP data in the industry, I think every MFD, every advisor I speak to will tell me that, look, based on your goal, you should have an allocation, and maybe an aggressive allocation is 70% equity, 30% debt. But yet, when you look at the SIP data for our industry, you will find that almost 95% is just equity. Okay. So how is it that, with 95% of equity, you could be following your goal? Now, it's a very simple hack. If your allocation is 70-30, let's say equity to debt, why wouldn't you have your SIP in exactly the same proportion? And that's just telling you that, we just have too many people coming into the market to make returns or, make quick money, get rich, but
so
not.
So when you talk about a goal post, right, you say that an investor should have a goal post. What should your goal post be? Should it be your financial goal in the sense of, say, I'm saving up money for my children's education or for my retirement? Or are there any other goals that you're talking about?
No, absolutely. So we would recommend that, you have your specific goals, and these are obvious ones: retirement, education, even buying an asset, a holiday, things like that. But moving towards each of those goals is a far better strategy than just trying to make money, is the point.
Okay, got that. So don't just try to chase an amount per se. Have a financial goal, stick to that and work with that, is what you're saying. Got it. Let's go to investment mistake number 2, and this is something that most of us are guilty of, right? Following the herd. Now, what do you mean? Is it going with the flow in terms of trending stocks, buying them and getting stuck at higher levels? And what should people not do in such a case?
So what we are seeing from, again, some of the data that you look at, firstly, when we look at mutual fund buying behavior, right? It's worrisome to see that just about 50% odd of mutual fund schemes stay beyond 2 years. So at one level, you come in to buy a pooled investment vehicle for the long term, but yet the behavior seems to tell you that, within 2 years, you're somehow disgruntled with that fund and you flip over to something else, right? So that's one thing that worries us. The second is, when you look at data for any wave or any period in the market, you will see an emergence of one sector or one type of scheme that seems to be suddenly favored by all. Last year it was sectoral and thematic funds. This year it seems to be mid-cap, then moving to small cap. And you wonder that, if people really had a goal, why would you keep shifting in such a large amount the type of scheme that you want to buy? Which keeps telling us that, look, what we seem to be doing as investors is just going with the trend rather than going back to saying, look, what is my objective? And shouldn't I be staying longer on that objective by holding on funds for a much longer period of time?
So what do you do at a time like this? Because, sometimes these trends work for a long period of time. So, for example, defense stocks, right? They are trending, so to speak, but that trend has been going on for like 1.5 years now.
Right.
Do you stay away entirely from this, saying, it's okay, I'll stick with the safer stocks, or do you pick up some of these trending sectors?
So nothing wrong in looking at trending sectors, trending themes, etc. But a lot of seasoned investors will apply a core and satellite approach, where you say that, look, a core part of your portfolio is the long, stable, steady, which is largely where you'll stick to the the flexi cap, multi cap, large cap oriented type of stocks or funds. And then you have themes that can sit on top, which are slightly more an overweight position or a riskier position. Now, one should worry when you're putting your entire portfolio of risk at risk, chasing a theme. So that's something that we think one should try and avoid.
Okay, try and avoid chasing a theme. Got that. Investment mistake number 3, aborting your investments too early. Now, by too early, do you also mean that, selling out of fear? Because I remember a lot of people in 2008, not just in 2008, even in 2020, sold when there was this massive pandemic or when there was a recession. One tends to get a bit scared when things like this happen. Is that what you talk about, or is there something else, a bigger mistake that people make?
No, so that's largely it, which is that I think when we look at market data and juxtapose that with flow data, which is how much of flow or buying or net purchases are happening, one sees a trend where you say that when market returns tend to be flattish or negative over the recent past, flows come down or may go into negative even. And we've seen this over periods of time that, there's a lag between markets stabilizing or correcting, and then, after a few months, you see flows coming off. And it seems to suggest that a lot of people look at previous 1 year or whatever their review period is, and, if it turns negative, they redeem. And which to us is a very large mistake, because study after study after study is telling us that, as an example, we did a study to look at, SIP behavior. So, should you just have continued your SIP, what would have happened, right? So if the last 1 year SIP return for you was very positive, let's say 20% and above, versus your last 1 year SIP return being negative, guess what? Over the next 5 years, the best performing, SIP would have been where your last 1 year was negative, which is in a sense obvious to market players because it's mean reversion. But it's something that most investors miss out because, at 1 year negative returns, what you see is a lot of people redeeming and saying, oh, actually, my fund is not returning me enough and, this is not a good fund, etc., etc. When actually the probability is very heavily stacked in your favor of making very good returns over the next 5 years. So you're missing out on that upside because you're just being too short-sighted.
Okay, well, so a lot of mistakes we've spoken about, right? Let's move on to investing mistake number 4, which is moving your goalposts. Now, is this more with regards to timing the market? And, what do you mean when you say don't move your goalposts?
Okay. So let's assume I came into a portfolio of funds. And, when I came in, my expected return was, let's say, 15%. Just an example. I would be happy to get 15% returns from my portfolio, and I bought a bunch of funds, let's say 5 or 6 funds. After a year, it may well be possible, after 3 years in this case, when we've done the study, that you were actually very close to meeting your portfolio returns of 14-15%. But then you see the individual funds, and then you see something at 25% and something at maybe 5%, because there's a range of returns across the funds that you've got. And then you make the fatal mistake of saying, oh, actually, why should I stay invested in this underperforming fund at 5%? And I should move all my money into this outperforming fund at 25%, because that's the best fund. Okay. And then, 2 years later, guess what?
If a fund is underperforming, there could be a reason for that as well, right? Maybe the fund manager has left, the other new fund managers come through, doesn't have the same kind of stock picking skills. So what do you do if your fund is underperforming in such a situation?
So definitely, if those were to be the answers, which is that, oh, there's something really wrong, please go ahead and make the choice. No one's restricting you. But often what happens is that, this fund took a series of steps or calls which have not worked in the past, which means that the probability is pretty high that it will work quite well in the future, which is what we keep seeing after every cycle. In most of these studies, you'll see that the best performing funds often don't repeat themselves over longer periods of time. You know, there's a certain cyclicality in the market. So in this study, for example, the bottom performing fund actually turned out to be the top performing in the next period, and then, you know, somewhere, the next set came in the third period, etc. So the point is that, look, one should have been reasonably happy with the average return your portfolio is making, because you were meeting your goalpost. But suddenly you shifted, 14% was fine. Why were you so, almost like, why were you reacting to the fact that the 14% will be an average of something which is 25 and something which is 5, and then make the mistake? Had you just stuck through, you would have made reasonable returns. But because you reacted or overreacted, you end up making these mistakes, which is really avoidable.
Okay, so patience largely is something.
Patience, and don't, your goalpost was 14, you were doing that. Why were you getting tempted with 25? You shouldn't have.
Yeah, okay, got that. That's some very sane advice, actually. Let's do one thing. Let's take a quick commercial break on that note. When we come back, we will continue to talk about all the mistakes that you should avoid in your investment journey. Stay tuned.